diluted EPS. Okay? In this chapter, we talked about the basic EPS calculation, which is net income minus preferred stock dividends divided by the weighted average number of common shares outstanding. And remember, on page 1 of your class notes, there are 3 different scenarios that talk with you about how to treat preferred stock dividends. So I will just say page 1. Also on page 1, at the bottom of page 1, it addresses what to do if you have, if you have a net loss. How do you treat that in calculating earnings per share? Okay? So that pretty much takes care of the numerator. So now we got to talk about the denominator. The weighted average number of common shares outstanding for the period. Okay? The key here is knowing that there are 2 things: stock splits and stock dividends that must be treated as if they occurred on the first day of the fiscal year, regardless of when they might have actually occurred. Excuse me. If you are presenting comparative earnings per share data, meaning for 2 consecutive years, if your stock split or stock dividend occurs in the 2nd year, you have to treat it as if that stock dividend or stock split took place on the first day of the previous year. It's the first day of the earliest year presented. You treat a stock dividend and a stock split as if they occurred on the earliest day of the first year that is presented. When you did the Gleim questions for chapter 16, we had some of those. And we had to go back and treat the stock dividend or stock split that occurred, say, in year 4 as if it occurred on the first day of year 3 when we're presenting comparative data for years 3 and 4. If you're only presenting year 4, then you only have to treat it as if it happened on the first day of the year for year 4. Okay? All right. Then there's this idea of potentially dilutive securities. Potentially dilutive securities. Now, what did we say potentially dilutive securities are? Something outstanding that has the ability to become additional shares of common stock without the company's permission. There's something outstanding that has the potential to become additional shares of common stock without the company's permission. Now, what are some of those potentially dilutive securities? First of all, convertible bonds payable. Convertible bonds payable. Also, convertible preferred stock. Convertible preferred stock. Okay. Next, stock options. And lastly, stock warrants. All of these have the ability to increase the number of common shares outstanding. Therefore, you have to take them into consideration when you are calculating diluted EPS. Diluted EPS. Okay? So, if no potentially dilutive securities, then you calculate basic EPS only. Basic EPS only. If potentially dilutive securities exist, you must calculate basic EPS and diluted EPS. You must calculate both basic EPS and diluted EPS. Okay? Now, the only other things, you need to be able to prepare journal entries related to stock option plans and bonds that have detachable stock warrants. And remember, you either have the incremental method or you have the proportional method. The incremental method or the proportional method. When do you use the incremental method? When you're given the fair value of one of these, the bonds or the warrants, but not both. When you use the proportional, when you're given the fair value of both, but the fair values do not total the proceeds that you got. If they total the proceeds, that's pretty easy. Just put the fair values in there. If they equal the proceeds, prepare your journal entry. Pretty straightforward. I think one of the homework problems, maybe problem 1 from this chapter that I gave you, the fair values did equal exactly the proceeds. Now, if you went through and did the proportional method, you'd still get the same answer, but you've done a lot of work that you didn't need to do. See, that's the point. Don't spend 10 minutes because you're not going to have an extra 10 or 15 minutes on the exam to do all that extra work when you don't need to. Questions from chapter 16?
Can you just briefly go over how to calculate the dilutive EPS for each of the potential dilutive securities?
What I do, let's do a problem.
Okay.
It's easier to do that than just make up numbers. So let's go to chapter 16.
Well, I just talked to you in class, after class one day, and you said that there's a specific way that you do each one of them that, and
Yeah.
I just want to review that.
Well, that's how I do every one of them, though. That's how I do it.
Yeah.
Is you test them. Mm-hmm. So let's go, let's problem 5. Let's look at problem 5. Problem 16-5. I don't remember if it asked us, but remember, we have to calculate basic EPS first before we try to do diluted EPS. Okay, so let's look at this problem. Amy Dyken, controller of Fitzgerald Pharmaceutical Industries, a public company, is currently preparing the calculation for basic and diluted EPS and the related disclosure for Fitzgerald financial statements. Below is selected financial information for the fiscal year ended June 30 of 17. You see all the balance sheet information, and looking through the balance sheet information, I see long-term debt, notes payable 10%. Well, since that's not convertible, excuse me, that's not potentially diluted, so I don't have to worry about the notes payable. Next, I have 8% convertible bonds payable. Okay, I'm going to highlight convertible because that tells me these are potentially dilutive securities. Then I have 10% bonds payable, which again aren't convertible, so I don't have to worry about testing them. Next, in stockholders' equity, I see preferred stock, 6% cumulative. Okay, I'd highlight the word cumulative because that tells me one of these three things here. I have to subtract preferred stock dividends for this year, even if they were not declared and paid by the corporation. I still have to subtract them per the three rules that are on page 1 of your class notes. But these are not convertible, so the preferred shares are not potentially dilutive. Then it says I have common shares outstanding, I have additional paid-in capital, and I have retained earnings. Then they give me a lot of additional information down below. Since I already know I have some potentially dilutive securities, I want to go ahead and write them down. First, I remember I had some, was it notes or bonds? Bonds payable, 8% convertible bonds payable. Okay? Then, in the additional information, it tells me that, excuse me, that there were options that were granted on July 1 of 16. Okay, now here we got to pay attention. The company's fiscal year ends on when? June 30 of 17. So when was the first day of the year? July 1 of 16. A fiscal year, remember, is any 12-month period other than the calendar year. And this is one of those periods. So it was, these options were issued on the first day. And remember, stock options always have the potential to be dilutive. All right? These were granted on July 1 of 16 to purchase 200,000 shares at $15 per share. Although no options were exercised during fiscal year 17, the average price per common share during the year was $20. Okay, are these going to be dilutive? Yes. Okay? So, I'm going to write out here, test for dilution. And I'm going to test each one of these. Well, I don't know enough about the bonds yet, but I do know enough about the stock options. Remember, the formula that's at the bottom of that page, back in the book, says take the average market price, is it 20 and 15? Take the average market price of $20 minus the exercise price of 15 and divide by the average market price. whenever the average market price during the year is greater than the exercise price, these options are going to be diluted. And then you multiply this times the number of options outstanding. So 20 minus 15 is $5 divided by 20 is 1/4 times 200,000 is 50,000. So the numerator will be plus 0. The denominator is plus 50,000 shares of stock. That's my dilution test. Are you with me? Okay? So we know when we do diluted EPS, we're going to have to assume these are exercised. And you should know, just automatically should know, that stock options do not ever affect the numerator. Because look what the numerator is made up of. Net income and preferred stock dividends. So if you issue more shares of common stock, it's not going to affect net income and it's not going to affect preferred stock dividends. So stock options never affect the numerator. All they do is they have the potential to affect the denominator. And if you add 50,000 to whatever you got in basic EPS, you spread the same size pie into 50,000 additional parts, you're going to get a smaller amount, so it's going to be dilutive. Right? That's important. Okay? Let's look at number 2 in the additional information. Each bond was issued at face value. The 8% convertible bonds will convert into common stock at 50 shares per $1,000 bond. Okay, now that's information we need. The bonds are exercisable after 5 years and were issued in fiscal year 16. So they've been outstanding again for the entire year. Are you with me? So now we're going to test these bonds for dilution because now we have the information. If the bonds that we have in question, this $5 million 8% bonds, are converted, then interest expense on those bonds will go away, right? And these are $5 million bonds that have an 8% interest rate. But we don't get to keep that dollar for dollar, do we? We have to pay income taxes on the reduced interest expense. What is the tax rate? Number 6, it tells us how much net income was for the year, and the average income tax rate is 40%. So how much of the savings and interest expense do we get to keep? 60%. Okay? So that's how much the numerator would change when we do the calculation in a moment. That's how much the numerator changes by. Now the denominator, it says each $1,000 bond, and there's 5 million par value, divided by 1,000 would tell you how many bonds you have, and it says each bond is convertible into 50 shares of common stock. $50 shares of common stock. Are you with me? So if we do the calculations, 8% times 5 million is 400,000 times 60% is 240,000. And then 5 million divided by 1,000 will be 5,000 times 250 times 50 is 250,000. Now somebody with a calculator, what is, just do 240 divided by 250?
0.96.
0.96. Now, unfortunately, because we have not calculated basic EPS, we do not know whether or not that is dilutive yet. But this was the question that Ms. Williams asked, so I'm addressing it, but we'll do the whole problem. Are you with me? Can you do that? Do you understand every single segment or part of that calculation? Because you need to understand that.
What would you do with that though? Like, so from here you would calculate EPS to find out if it's diluted.
Right. And then I'll know whether or not I got to consider it in the diluted earnings per share calculation, which I'm going to do in a minute. Okay? Now go to number 3. The preferred stock was issued in 2016. So that tells us we need to subtract an entire year's worth of preferred stock dividends in my basic EPS calculation. There are no preferred dividends in arrears. However, preferred dividends were not declared in fiscal year 17. Well, that's okay. They don't have to be because these are cumulative preferred shares. You got to subtract 1 year's worth of dividends anyway. The 1 million shares of common stock were outstanding for the entire 2017 fiscal year. And net income for the year was $1.5 million. Okay. So, in my calculation, I would have 1,500,000 minus, how much is the dividend on the preferred stock? I see 1,250,000 as the total par value times 6%. 6 times 5 is 30, 0, carry 3, 6 to 75,000. And they tell me, I remember in that one of the last items, we had 1 million shares outstanding for the entire year, which I can verify by saying 1 million divided by the $1 par tells me there are 1 million shares have been issued. There are no shares of treasury stock, therefore they've been outstanding. So somebody, what is this? $1.43?
Yes.
So on the exam, I would be looking for basic EPS and $1.43 is your answer. Okay? Now, remember for dilution, after we go through the dilution test, we rank our answers from smallest effect to largest effect. Okay, so which one of these would be first?
The stock option.
Because the answer is 0. 0 divided by anything is 0. Therefore, this is the first one that we will bring in, and this one would be the second. Okay, now 96 cents is less than $1.43, so it appears that it's going to be dilutive too. Right? See, I'm testing the answers that I get here against the answer that I got here, and I'm saying both of these are still potential.